Hey folks, welcome to Business Redefined, your weekly most comprehensive look at the world of business, finance, and economics. We want to talk about the IMF program, which was signed in March 2021 and lapses in March 2025. As we speak, we are in anticipation of the Executive Board meeting on the 7th review. Who better to comment on this matter than Peter Doyle, well-renowned economist? Anytime I put his content out, the engagement on Twitter or X, as you wish, is quite massive. Peter, welcome on set.
Thank you very much. Pleasure to be here.
And glad to have you in Nairobi. Welcome again.
Thank you.
Peter, you released a report in partnership with the Institute of Economic Affairs titled, "And Then the Flood," speaking really to the IMF program, the nuances that define it. For those who might not have interacted with it, just give us a brief overview of why that report, what it speaks to, and your broad thinking about Kenya's program.
Okay, so I was asked by a group of academics called Ideas to do a review of the IMF program, and I was very happy to do it with the Institute of Economic Affairs in Kenya. So that was the initial spur to the work. In terms of the way in which we set about the work, what we really wanted to do in terms of assessing whether the program was either necessary or not, or whether it was well designed or not, was to start by looking at, if you like, the antecedents to the problem. What were the problems that the Kenyan economy had prior to the beginning of this program? And in light of that, to assess whether or not the program was needed and well designed. So I could quickly summarize for you some of the key issues in the antecedents that we saw. We see over the very long period, say over 30 years or so, that the Kenyan economy is growing slowly relative to what we call its best peers. That's our countries internationally at roughly Kenya's GDP per capita, who are performing well. Some of those are in Asia, so Vietnam, India, Cape Verde, and others. So there we saw a growth problem. In terms of diagnosing why Kenya was growing slowly, one of the things we then did is identify and investigate whether fiscal policy over the very long run in Kenya has been in some sense misspecified, and we concluded that it was. So we see a fiscal root of slow growth. But what we found was that it had two components. One component was many years, in our view, budgets in Kenya were far too tight. There was far too little spending on health and education and growth, which is why the Kenyan economy was growing slowly from that side. And then more recently in the 2010s, we see the opposite problem, where the fiscal became far too loose and it was clearly producing disorder in the macroeconomy in Kenya. And then we thought, well, what were the consequences of that disorder in the 2010s? And one of the conclusions that we drew, one of the things we saw, was that the orientation of the economy really radically changed after about 2010. Up to that point, Kenya had clearly been an outward-oriented economy, exports growing relatively quickly and being the real driver of growth in the economy. After that point, it completely reversed. Export growth began to significantly drop relative to GDP, and we traced that back to the fiscal expansion, causing the central bank to raise interest rates to stem inflation, causing a big appreciation of the shilling, causing difficulties for exporters, for manufacturing, and so forth. Yeah. So we saw an orientation problem which we thought was severe, and concluded by a sort of very careful analysis, in our view, that by about 2019, the Kenyan shilling was probably something like 20% overvalued relative to what we would call fair value, relative to a value that would retain the outward orientation. We have a number of antecedents that we tracked. We looked at the land issue, we looked at the COVID shock, we looked at the rise in global interest rates that really happened after 2020 and into 2021, and of course the droughts. And a particular point that was striking to us was, the finding, the report, that in this country, 1 out of 5 children are stunted. Yeah. And that's indicating that they are not matching the height for their age that is normal. And that's reflective of severe, protracted deprivation. So that was the mix of factors in the antecedents. And given that at that point, not only global interest rates were rising, but as your viewers will recall, there was a large bullet maturity coming shortly on its Eurobond, we certainly concluded that an IMF program was needed.
I see. Very good introduction there. And on the orientation of the economy, one of the things which I found interesting in that report actually was, if you look at the 2010s, Peter, you'll remember we had the collapse in global commodity prices, whether it was oil, coffee, tea, etc. And I thought perhaps the report didn't do justice in appreciating that context, because what could have happened is Kenya definitely lagged in getting out of that hangover from the price shock of the global commodities. Do you feel that perhaps you didn't give enough grace on that account?
There are, how should I put it, there are many factors that go into an antecedent analysis. There are many more that I haven't covered. Do we think that that particular one was a significant one? Do we think that the design of the program itself, or the need for the program itself in 2021 was greatly influenced by that? Not I think so. That was a significant issue at the time that you mention it. So back then, 2011, 2012, absolutely, the collapse in export prices was a very severe issue. But that largely reversed. I mean, don't forget, by the time we get to the mid 2015 and so on, the global economy is going very well, so much so that, the fund is talking about Africa rising and so on in this sort of boom time. It's an open question whether they should have been talking in that way, and perhaps we could follow up. But by the time we get to 2021, I think that is significantly in the rearview mirror. Although I take your point that it remains, if you like, an issue that the Kenyan economy remains so dependent on those particular kind of commodities. That is a factor, and that goes into our issue about orientation. If we are correct and the exchange rate was overvalued, well, that is a big impediment to the expansion of other sectors, a big impediment to expansion of manufacturing, for example, to diversify Kenya away from its dependence on some of those commodities. But the shock itself that you're talking about, rather than the broader implications, I think was largely in the rearview mirror by the time the program came to be.
I see. So now we get to 2021, Kenya signs the program. By your own indication, yes, Kenya did need a program at that point. But one of the issues which you flag in the report is the question of the primary balance. Your revenues less your expenses while deducting debt obligations. Why is that a very important consideration to make? And to what extent do you feel the fund didn't give it proper consideration in the context of Kenya's program?
Okay, so in general, it absolutely is a pivotal number in any program design. And why is that? It's really for two reasons. One is that if you look at the determinants, the simple determinants of the trajectory of public debt over the medium term, in any country, it doesn't matter, Kenya, any other country, there is an equation, the key element of which is the primary balance. There are other elements in that equation too, but what that number is determines the trajectory of public debt. And obviously, in any country, you don't want a country which is on an exploding path. You don't want debt to be rising indefinitely, because that is not sustainable. So it has, on the one hand, a direct implication for the trajectory of public debt over into the medium term. On the other hand, equally important, once you've got that number set, now you have an anchor for determining what revenue policy is and what expenditure policy is for the budget. Again, over the medium term. So it's determining, if you like, simultaneously these two absolutely crucial design elements in any country's macro framework. So that's why it's important. As to why we think, or what we think, how is a different issue. What we think went wrong, in our view, with the determination of that target by the fund for Kenya from 2021. Is a number of issues. One of which is, if you look at what the fund was saying about what Kenya should target for that number prior to the pandemic and prior to the program, it was extremely different from what it was saying at the point when the program began. So in the previous years, it was saying, the IMF was saying that Kenya should be targeting a primary deficit of 2% of GDP.
Yeah.
During the pandemic and prior to the program, they said, no, actually, it should be, in the medium term, a deficit of 3%. And then 6 months later, come the initiation of the program, they say, no, actually, it needs to be a primary surplus of 1. That is a change in the judgment of the fund of 4 percentage points of GDP. 4 percentage points of GDP is a quarter of Kenya's budget non-interest spending. It is a huge change in the judgment. That judgment, that change in judgment is simply not explained. The IMF do not anywhere in any of its reports explain why their view changed so suddenly and so dramatically. That's one of the problems. The second of the problems is, in our study, we looked at what was, from countries like Kenya, the behavior of the primary balance of the countries that did best over a long period, over 30 years, to get a sense of what the right primary balance a country like Kenya should be targeting if it wants to maximize its growth potential. And what we found there is that most countries which are performing best, these are the highest growth countries over a very long sustained period, run primaries of between 0 and -2. Okay, that's in Kenya's GDP per capita negative.
Yeah.
And we looked at them closely. Most of those countries, that's on average over 30 years. It's not only an average that they do that. We find that those countries which do best seldom go out of that band. That's where they stick.
Yeah.
And partly as a result, they boom. Okay? And when I say boom, you need to understand what that means. Over that period of 30 years in our study, Kenya's GDP per capita grew by just 25%. Its best peers' economies grew by 4 times.
That's huge.
So it's a gigantic difference implied by this fundamental, one of the issues is the fundamental difference in the primary balance. So another thing which we find no explanation for in the IMF report is why they are not recommending Kenya to follow best practice on this key number. First of all, they were advising Kenya to target below best practice. That's prior to the pandemic and so on. And then with the program significantly above best practice. No explanation for why Kenya should not be targeting best practice.
Yeah.
And if you allow one extra extension of the issue that we found, because one of the things you might say, as a sensible observer might say of Kenya, oh, come on, there was clearly a problem with the debt. We had to do something with the debt, therefore we had to raise. Fair point.
Yes.
Okay? So when we studied that issue, we found something which was even more puzzling in terms of the work of the fund. So at the point where the program was initiated, the debt trajectory that they were anticipating, with all the conditionality met, would be that by 2026, the debt to GDP ratio of Kenya, of the government, would fall to about 68% of GDP. Okay? That's what they thought. A year later, they did the projections again, the IMF staff, and now they say 2026 is going to be 58% of GDP.
That's a stark difference.
Much better.
Yeah.
And yet, this primary balance target doesn't move. So we said, why is that? If the primary balance target outside of the best peer band is motivated by debt concerns, why doesn't it come back into the best practice band when the debt trajectory suddenly, in their own projections, looks 10 percentage points of GDP better? So we find no connection, no logical thread explaining why they just stick so vigorously to this 1% of GDP number.
Okay. Interesting perspective there, Peter. And my own thinking, and I've mentioned this to you before, is that when I try to rationalize why IMF sticks to this 1%, if you do the math, it looks like they are targeting at least a month's worth of tax revenue collection by Kenya's numbers. So in any financial year, the program is designed to ensure you at least have a 13th month by way of surplus in collection. Would that make sense for you?
Some programs do that. I'm not sure that this one does. So that the anchor conditionality is the medium-term target for the primary balance. That is decomposed then into the annual trajectory to get there. Okay? So the IMF then backs out from its medium-term target what the target for this year has to be, and then it sets those into quarterly performance criteria on the fiscal. It is always looking, when it's doing that, to find some form of buffer.
Yep.
It knows that things can go wrong in any number of ways, and as you say, you describe that as a 13th revenue month, if you like. But it's always trying to find some kind of buffer, because there's always something that's going to happen in the fiscal. Yeah. And that is a sensible thing to do. But one of the things I think they have found particularly difficult in doing that, in this particular program, is that because the IMF program was not designed around the antecedents that we found, they simply ignored the misalignment issue, they ignored the land issue, they ignored the stunting issue, they ignored all kinds, they ignored the low growth issue. One of the problems that they've had is that GDP growth of Kenya has consistently underperformed their projections. So if GDP growth is underperforming, revenue is underperforming, and the fund ends up chasing its tail. Yeah. So revenue has come short, so then they come in with new tax raising demands to try and put it up, revenue up, to do a catch-up exercise. And that was particularly severe out of 2023 into 2024, when it was really clear that output had fallen short. And as a result, the IMF team came here, I believe it was in March, and then once again making demands in the mid-year for really dramatic, sudden changes in the tax demands, which produced a raft of further tax increases in the finance bill, which put the whole country into a very difficult position, producing the protests and eventually producing withdrawal of the bill. So yes, they always try to put in those buffers, as you mentioned, but if the fundamental design of the program, the projections for GDP growth, are systematically wrong, no amount of 1 year buffer is going to offset that. You are blown out the water, and that's what's happened to them.
Peter, I take a different view, and here's my argument. Even if Kenya did not have the IMF program, because of the global funding squeeze and the fact that for a long time, countries like Kenya could not go back to the global markets to raise capital, the push for domestic revenue mobilization would still have been there, whether or not we have an IMF program. And you can see it across frontier markets. So don't you think that the conversation of ramping up domestic revenue mobilization is worth having?
I'm going to make your point even more strongly than you did. Had there not been an IMF program in place, I think it's not that the revenue push would still have been there. I think it would have been even bigger, because the confidence that would have been that was given by the fund program, misdesigned as we thought it was, nonetheless gave some kind of cushion. Without that cushion, the signal that the governments would have required to give to markets would have needed to be, if you like, that much stronger. Okay. Yeah. So I think your argument actually is the pressure could have been even greater still. All right. However, that still leaves a question that with the program, what was the right kind of revenue and expenditure balance that program should have targeted? Because even if you're aiming for a specific primary balance target, there's a question about how you get there. Do you do it by raising taxes, or do you do it by adjusting spending? Either will deliver you the primary balance. Yeah. And that is a core issue which I think is simply, again, not explained, what we have found in our work, not explained by the IMF. They do not explain in any way why they argue that the right balance in the program was to raise revenue rather than to cut spending. I think a number of Kenyan citizens might find that extremely puzzling. There's a common view here, and I think it's pretty well grounded, that there is a lot of waste in spending, and therefore that that a key driver, if you're aiming for a primary balance target, is to work there. And on the other side, I think a lot of citizens would say, actually, households in Kenya were facing a great deal of difficulties over this period, in particular from rising food prices and other things. The last thing they needed was higher taxes. They're not arguing up against taxes in principle. They're saying right now, when this particular food shock is going on, is not the time to try and get this particular, if you like, fiscal action taken. None of these issues that I'm teasing out here appear in discussion. Indeed, one of the things I find quite remarkable, having read myself over 1,000 pages of IMF staff reports to do this work, there is a single sentence in there which explains why it's tax ratios that need to go up. And that sentence says that tax ratios are required to support Kenya's developmental needs, period. They never explain what Kenya's developmental needs are. They never explain why revenue increases are the way to achieve those developmental needs. It's simply not explained. It's simply announced by fiat.
Yeah.
Okay? And yet, as I've indicated to you, when we look at sort of the Kenyan economy, we see two strong counter-arguments. There's clearly space on the expenditure side to act. And this context was not the context to have tax rises.
I see. Peter, what do you feel about the way Kenya went about refinancing the $2 billion notes, which matured in June this year? And I ask that because for the many who have argued in favor of the IMF program, the argument has been, and I buy that argument, without the IMF program, we probably would have been in the same basket as Ghana, Zambia, and Ethiopia.
Okay, so I mean, let me take that in two parts, if I may. The way they set about it as an administrative exercise was with very great vigor. There was a huge amount of effort put in across the board in government to get the fund program going, to get it compliant with the program, signal that to the markets, the whole process of finding potential buyers and eventually paying an extremely high premium for it. So an enormous amount of administrative effort. On your second way of posing that question, would Kenya have ended up, as you put it, in the same basket? And the implication, the way you phrase that question is pejorative. Would we have been along with the bad boys club of those other characters?
Of the defaulters.
Let me try and address that perhaps in a somewhat provocative way. I saw the interview with Meg Whitman the other day on television, and one of the things she said about this general question was that Kenya's top priority is to pay its debts. And she said, and we, speaking for the United States, agree with that. That's a statement with which I fundamentally disagree.
Yeah.
The top priority for Kenya is to service its citizens and to grow. That's the top priority. And there are times when that is, and other times when it isn't, consistent with paying debt. And Meg Whitman knows that very well because she has a corporate background.
Yeah.
She knows about Chapter 11 bankruptcy arrangements in the United States, the precise purpose of which is to allow corporates to grow by shedding debt. It is simply not the case that the only way to grow, either a corporate or a country, is to pay its debts. Sometimes in order to grow, both a corporate and sometimes a sovereign must shed its debts. And there are powerful cases in the world where you can see this, in the case of sovereigns, that the shedding of debt proved to be absolutely central to subsequent booms. I quote the example of Poland in 1991. I quote the example of Bosnia and Herzegovina, a case I know particularly well from 1995. I quote the case of the Dominican Republic under the Brady Plan, where they all had significant debt write-offs to a degree sufficient to allow those countries to run best practice primary balances. All of those three countries are now amongst the best growing countries over the last 30 years. Okay?
Yeah.
And that is because all three of them were able to shed their debts to a degree sufficient to allow them to grow. So far from looking at such countries as in the bad boys club, I think people need to think much more subtly about it.
Yeah.
You can always pay debt. A country can always pay debt by driving itself into the ground. And there are plenty of countries around the world which have done that. And one of the implications for Kenya of having a primary balance that is above best practice is precisely that. Kenya is, if you like, making that deal to accept low growth because it's not able to put the resources now going into debt service in order to promote growth.
Yeah.
Okay? And what happens in countries, including in Kenya, is the balance of these issues shifts over time. It's not like a country 1 minute is obviously in a position where it should shed debt. Sometimes it appears progressively. And what we see over time through this program is that Kenya is moving in that direction. And it's not just the three of us who see that. One of the things that we have done in our study is we've looked at what market assessments of Kenya have been across this program. And one of the points of the program, and one of the points of all IMF programs, is to improve access successfully is the spread.
Yeah.
Okay, the spread over of domestic issued government debt in Kenya compared to parallel maturity debt issued by, say, the US government.
Yeah.
And what we see is that far from that spread narrowing on the course of the program, it's been widening, and significantly. And it remained wider even after that bullet maturity was refinanced in February, okay? Which indicates that it's not only the three of us who see that this is heading in that particular direction for Kenya, it's also financial markets. And I know one of the things that upsets the authorities in Kenya now is the fact that they have to pay such high yields on issuing domestic debt. That is in markets anticipating that Kenya is heading into an area where it's not going to join the bad boys club. It may go into an area where it needs to shed debt in order to grow to its potential and therefore create jobs to its potential.
When you talk about shed debt and the examples you've given of the countries which went through that, how does it contrast or how does it align as well with what we had in the mid-90s, the HIPC initiative, the highly indebted poor countries? And why is it that in your examples, for example, there is no African country, given what we went through in the mid-90s?
A very, very penetrating question. As I have separately looked elsewhere at how the HIPC was conducted, there are many kinds of critiques of that. From my point of view, the analysis that I have done shows that a core problem with the whole HIPC agenda was that the amount of debt reduction that was offered to the HIPC countries was too small. That even after the debt reductions which they got, and many of them were African countries, as you know, all right? Not all, but many of them. The amount of debt reduction that they were given under HIPC was insufficient to allow them to run these best practice primary surpluses balances thereafter. All of them should have been running deficits thereafter, given their GDP per capita numbers. But in fact, a whole bunch of them were forced to run primary budget surpluses, not spending on health, not spending on education, and so on, to pay the debt after reduction. In other words, the amount of debt reduction that was given under HIPC in general across the board was too small. There are one or two small exceptions. And there's one very recent exception to that, which I really wish to draw attention to, because it's a case where I applaud what the fund has done, which is in Somalia. If you look at which is another recent case, if you look at what they did in Somalia, they've produced such a large reduction of the debt of Somalia that from this point forward, Somalia is able to run best practice primary balances into deficits. Yeah. Now, of course, that is now, in my view, a necessary condition for long-term growth of a country. There are many other things that Somalia will have to do to make best use of that leeway that it has been given. But I want to make very clear that in that specific HIPC case, which is a very recent one, I strongly applaud what the IMF has done very recently. They've really done their job well there, I think. It's my view. So an issue is not just, do you get debt relief? Are you in that club? The question is, have you got enough debt relief under whatever deal was done? in order to allow you thereafter to run these best practice primary surpluses in the medium term. And for most countries in the HIPC, the answer to that is clearly in the negative. It was too small.
I see. Peter, I'm being wound down on our time here. We've actually overshot. Quick one, as we wrap up. Kenya's program with the fund is due for lapsing on March 2025. There have been indications that the government of Kenya is already scouting for a fresh program. This one cannot be extended because, of course, it has maxed out the 4 years. Do you feel Kenya needs another IMF program, and would it be the best route to go?
With respect to myself, it's not really up. My opinion on the subject doesn't really matter. The markets think that Kenya needs another program. If it had been the case that those yield spreads that we spoke about had fallen during the program, that would have indicated that the markets are thinking that Kenya is on a trajectory to sustainability and to exit. But as we noted, those yield spreads have been rising, and considerably, indicating that the markets themselves do not think that Kenya is yet in a position, if you like, to be able to stand on its own 2 feet. And what they see is what I am also seeing, is that this debt problem is becoming more and more intractable. The citizens have clearly indicated that their patience with these increasing primary balances has run out. So scope to keep pushing them up is limited. They also see clearly the considerable strains in the government of Kenya in terms of managing this this requirement from the markets to put the primary balance up against the opinion of the population, which says that we have had enough. They're seeing a combination of these problems. They also see that interest rates in the world, in the federal, in the US and so on, remain high. So even if they may start dropping a little bit from now, they remain elevated. What my opinion isn't so important. The markets are saying. And what that means is if it doesn't happen for any reason, I think Kenya might find itself even more exposed. That still leaves the question, if I may close on this. Needing a program is one thing. What Kenya really needs is the right program at that point. Not a program, but the right program, which means that very careful consideration should go in, especially on the side of the Kenyans, to thinking about what the right design is, so that this time, unlike the last time, they sign on to something which might actually work.
Final question, Peter. My own view is that Kenya's biggest headache as far as debt goes was not the Eurobond, was not obligations to China or TDB, is domestic debt. If you look at our expenditure on redemptions, on interest, a huge chunk is domestic. What do we do about domestic debt?
Well, let me say about that, is that the problem, or is it a symptom of the problem? As I mentioned earlier, most countries in Africa, and the countries, are desperately trying to expand the pool of domestic borrowing that they do. They'd want to expand their financial sectors to be able to do that, and think that would increase their options for financial position. And largely they are correct in that view, in my opinion. What's happened, and why I think this has caused such a difficulty in Kenya, and why you're picking up on it, is that in the context where the fundamental macro in Kenya is as fragile as it is, the domestic creditors in Kenya are saying, we want to have a risk premium in our yield to reflect those difficulties. And that's reflecting in the yields on domestic debt, causing precisely the problems that you are talking about. If I'm right in that, and I may not be, but if I am right in that way of framing it, then the core problem is not domestic debt. That's a symptom. The core problem is the management of the entire debt, domestic and foreign, and those would need to be resolved together.
Thank you so much, Peter Doyle. We've been having a conversation with Peter Doyle on Kenya's IMF program, specifically drilling down to the question of, was it well structured? Was it suitable? If we go for another program at the lapsing of this one in March 2025, how should it be designed? And finally, on the question of domestic debt, we'll be keeping an eye on this issue to bring you the latest, so stay tuned.